just back for Indian markets. Benchmark indices are trading with gains of 2%, keeping up the momentum gained on Friday. The government's decision to cut corporate tax rates have only fueled expectations of higher profits, something that's been elusive for a year now. But is it too early to celebrate, given that the consumer hasn't got much directly? Let's ask Prashant Jain, the Chief Investment Officer at HDFC AMC. Prashant, thanks very much for taking the time. A really big booster shot that was given on Friday's session. And this definitely changes the narrative of India as an investment destination.
No, I think that's right. See, what was happening in India is last few years we were growing entirely led by consumption. And that consumption growth was also supported by falling household savings and rising household leverage. Actually, white-collar wages have been under pressure. So you could not have continued to grow despite low income through borrowings. And what we needed to do was to revive the capital expenditure cycle so that new companies are formed, new plants are put up. So you create jobs and then consumption can grow on a sustained basis. So I think the good thing in this is that one, it reverses the negativity in the economy, and which is very important. And two, this entire money will go to companies. And what will companies do with this money? I mean, it's at a gross level $20-odd billion. Companies will either cut prices, which is good for lower inflation, good for consumers, or they will put up new plants, or they will pay more dividends, which again money comes back into the system. So I think this is a very apt move, and despite a small fiscal impact of this, I still believe it is good, because right now the demand for credit is so weak that I don't think it will lead to any crowding out on the fixed income space.
Does this also reduce the pressure on banks, because now you've got more money in the system already? Or you don't think that will happen?
See, I think it might, I think banks should benefit over time, because the 3-year window that has been given, that you must attain commercial production by March 23, will lead to a huge urgency in terms of setting up new capacities. I think mainly I would expect the new capacities to come from outside India companies, global multinationals. And I think Indian companies could also chip in. So I think it should lead to enhanced credit growth over time on the capex side.
Right. Do you think this is a case of one stone and many birds at one time? Like, you've tackled, the on-ground, you've tackled job creation, you've tackled on-ground manufacturing setup, you've tackled corporate profitability and earnings. So it looks like a win-win on all counts except for the fiscal math.
See, I think you are right, and given time, that's how it should play out. See, I think we must keep in mind that it's a very opportune time to do this. And why do I say this? Because the largest economy in the world, the largest importer, US, and the largest exporter are trying to renegotiate the trade terms. And if you look at the region, Indian tax rates were becoming less competitive. I mean, whether it is Vietnam, Bangladesh, Thailand, Singapore, they all have much lower levels of taxation. Indian wages are now much lower than Chinese wages because of the very high growth in China over last 10 to 20 years. So the economics supports manufacturing in India when China, some factories relocate out of China. And if you don't have a competitive enough tax rate, these factories, some of them at least, would have gone to neighboring countries. So I think this was good both from a local reviving capital expenditure cycle point of view, and also for taking advantage of this once in a lifetime opportunity. Because once the factories relocate out of China into some other geography, they are not going to relocate once again.
They're going to stick.
So I think it's a very timely, very apt decision. And the fiscal slippage is a very small cost to pay. Look at it this way. In 2 days, the markets are up broadly 10%.
Yeah.
That means the wealth has increased by $200 billion. And 75% of the wealth, the shareholders are in India. So $150 billion increase. And yes, you have paid a small price, $20 billion. If you, of course, spread it out over 4 or 5 years, it becomes a bigger amount. But then if the economy starts growing faster, I think the taxes can come back in again.
So do we put the slowdown story behind us now?
See, I think the consumption slowdown will not stop, and I think this is the right way to go because you cannot go on consuming without income. And while everyone says India's household debt is below global benchmarks, global levels, but I think the point that is missed is that if you adjust that 20% household debt to GDP for the much higher interest rates in India, the interest expense is actually where the rest of the world is. So I think you can't sustain consumption through borrowings. You must earn and then spend. So I think this puts resources where they should go, that is to companies, because only when companies invest, locals and multinationals, that is the only time, I mean that's the only way you can create jobs and bring back consumption in on a sustained basis. So I think, to my mind, overnight we should not expect a revival in consumption.
Okay, but from an India standpoint, from a foreign investor standpoint, suddenly India starts to look rosy again. Earlier on there were question marks about whether or not valuations are supportive of the earnings growth, but now when that's been addressed, you know that you will get the earnings growth bump up on the back of these corporate tax savings. Do you see that the outlook for India as an investment destination changing?
So I think, see, people like me are always asked what's the outlook for markets, and I always respond by saying I don't know in the short run. And I think this is a great illustration that the I don't know is the right answer in the short term. But I have been optimistic on the markets. One, corporate profit growth is recovering in any case because the progress in IBC has been slow, but it is there. So I think the corporate banks should revert to normal levels of profitability by next year or by second half of current year. So I think profit growth cycle was in any case reversing, and this of course increases by more meaningfully, at least in the short term. I think the interesting point to look at Indian markets is that India's market cap to GDP is near all-time lows. And if you look at these markets X of consumption, both consumer discretionary and consumer staples, it is very, very cheap. Whatever parameters you look at, whether it is price to book, whether it is forward PE multiples, whether it is market cap to GDP, Indian markets are actually quite cheap, and X of consumer and I mean both consumer discretionary staples, I mean, I have rarely seen this kind of value in a long time.
So headroom is a lot more.
I think so. I mean, in the non-consumer, maybe, I mean, IT pharma also are at reasonable valuations, but I think the big change should happen in capital expenditure, in corporate banks, especially.
All right. So the consensus opinion up until now is in this period of slowdown, you know, while the rest of the broader market space does not appeal that much and you know, slightly questionable on the earnings, stick with quality, stick with the large caps, stick with the good parentage names. Does that start to tilt towards, okay, now I've got broader market stocks to look at, they are cheap, they've been beaten down 60-70%, so maybe start diversifying into the mid and small caps as well?
So I think, see, this whole debate of small mid caps and large caps, I think has been a very misplaced one. And
why do you say that?
See, businesses are small or large depending on the nature of the business. So I mean, if you buy an auto parts company, even if it's a leader, it is going to be a small. Mid cap company. If you buy a car company, it will be a large company. So I think this whole debate has been very, very misplaced to my mind. I think it makes more sense to discuss along sector lines, or whether you are in exports or consumption or discretionary or staples or capex. I think it makes more sense to discuss along those lines. So I feel
the business angle instead of whether
yes.
which.
See, a size is a function of the nature of the business. I mean, if you are making cycles, you will be a small mid cap company. So size is just a function of the nature. It has got less to do with growth, to my mind. So there are many cases, examples where bigger companies are growing much faster than smaller companies. But what indeed happened is that in the last 2-3 years, because of the extremely bad NPA cycle, many large corporate banks did not grow profits. In fact, profits degrew. And that did not lead to, that led to a situation where Nifty EPS did not grow. And therefore, small mid caps, in a way, I think they outperformed. And when something outperforms, a lot of money chases that. And that stock, in a way, ran much ahead of fundamentals. So I think coming back.
So this was course correction, according to you?
At least I have been of the opinion for some time that that whole argument for small mid caps growing faster was misplaced. And you can go back and see in maybe 7 or 8 out of 10 small mid cap companies, bulk of the returns have come from multiples going up and not from earnings. And I think that course correction had to say. So I would say we are in a situation where the returns of small mid caps and the large caps have converged once again. And I think it would, in future the deviation in returns between these two should be much less. I think the returns will vary more across sectors and less across capitalizations.
So in light of that, obviously, when everyone was talking about, and we spoke about consumption, and you said that, on all of those parameters, if you exclude consumption names, you are at the cheapest. But the point is, consumption is a big element in the market. And if you have to buy a consumption stock, after Friday's move, they've got even more expensive. So would you say that if you're going to buy quality, you land up paying the price for it and it's okay?
I think it's a very flawed notion that only consumption is quality. I think nothing could be farther from the truth. They are good businesses, they have a lot of franchise value, so they are very good businesses. But this definition of quality, I have seen it change so many times in my career. The same consumer companies were trading at 10 to 20 times 10 years back, 15 years back. So were they weaker quality then? They were the same quality. We have seen pharma correct by 70%. Has it become lesser quality? It has not. So I think this whole debate of quality at any price, and when the definition of quality keeps on changing, I think to my mind it does not make sense. If tomorrow capital expenditure starts growing faster and consumption does not grow, markets may again say, no, this is looking good. What happened to auto companies?
Yeah.
How have they suddenly become weak quality? The business is same. So
what happens now? Do you feel that obviously now this doesn't guarantee volume growth, but it gives them a leeway to tinker around with prices to make sure that they can push it in the system?
See, I think I am I am not so convinced that volumes in auto will come back in a hurry. One, I am sure the discounts are much bigger already than last
ahead of
year.
festive season,
And the retail slowdown in autos actually started last year. See, the numbers what we get in India are wholesale numbers. And industry does not share retail numbers. But if you look at the retail sales also, they have been degrowing. Not degrowing, they have been extremely weak for over a year. Pipeline inventories were rising. And now you have reached a limit of those inventories, and therefore wholesale dispatches are coming down very sharply. I think the retail sales are not as negative. So, but I don't see a situation where overnight things will change. See, why have auto sales slowed down? It is because, to my mind, that the wages in India have been weak. And the IBC resolution process, while it is very good from a longer term perspective, in the near term it has led to several job losses. And India's savings rate has fallen very sharply in last 10 years. Your household debt has gone up very sharply. People buy most of the things now on EMIs. Why? Because they are not able to afford cash down. So I think
and in that context, buying a car is an expensive proposition.
It has actually moved down the priority list because the mobile market in India, the handset market, is as large as the car market. And anyone would prefer, if you could choose between the two or you could buy only one, you would buy the handset first. So I think cars will grow over time. And just one final point on this, you would be surprised that even last 10 years, the car industry in India has grown at only, I think, 6-7%. Why? I mean, Maruti grew much faster because they gained share. So car industry was growing at low volume growth for quite some time, and I think the reason for that is very, very low wages in the private sector.
So you think this, so different opinions getting in. So we had, Mr. R.C. Bhargava coming in and saying, last time when we spoke to him, he said August would be the turnaround month. And then when we, August reported dismal numbers, he said that I'm confused. I can't pinpoint a time when I see a turnaround in the industry. And when you have, a veteran like Mr. R.C. Bhargava, who's seen various cycles saying that, it really puts it into a question. And you really wonder when things will actually start to turn around. And therefore, how do you base your investments in this sector? You wait it out or start?
Did you read his last interview, which he gave 2 days back? And he said, look, the challenge is wages. So the starting salary of our IT engineer in India was 2.5 lakhs in 2003.
Yeah.
And today it is 3.7 lakhs. So what does that tell you? It tells you the wages have grown 40% in 16 years. And in this period, you have this huge industry of mobile, which has LED televisions. So the buying preferences have also changed, but income has not kept pace. So, and that's why I think this is a more structural, more deeper problem. And I would not be so optimistic about the auto sales recovering. In any case, this tax cut does not go to the individuals.
Yes.
And I think that's the right way, because you must do everything to increase the income of the individuals. And that will happen only when companies start spending on new projects.
So tell me, Prashant, all variables kept in mind, the best investment opportunity or a space where it could have been a space which has been a favorite, or it could have been a space which was a laggard but now starts to turn the page. What would you do?
So I think as we discussed last few years, we have seen consumption was a very favored theme, and earnings have also done better, certainly much better than the other parts of the economy, and multiples have gone up very sharply. So I would say, except for consumer discretionary and non-discretionary, which are trading at very high multiples, and I think the growth expectations implied by those multiples, in my judgment, are unlikely to be met. I think X of this, the whole market broadly looks either deeply undervalued or reasonably valued. See, when price to book in India is near all-time lows actually. When your market cap to GDP is near all-time lows, and two sectors are at lifetime highs, it tells you clearly that rest of the market must be much below than what the aggregates are also suggesting. So I think that is how I look at this market.
And where do financials fit in?
Financials, I think, are in, most commentators like to discuss private versus public, but I feel it makes more sense to not focus on the ownership, but instead focus on the nature of the business. So I think if you look at banks, there are banks which have suffered due to high NPAs, corporate NPAs, and there are banks which have not suffered. Banks which have not suffered are very high quality businesses. I think they are reasonably valued. They should continue to grow. But the other banks which have suffered high corporate NPA stress, I think that stress should come down, and we are already seeing significant improvement this year. And I think as we go into second half of this year and next year, I think we should see near normal levels of profitability in these large corporate banks.
But PSU banks you wouldn't look at, would you? What did you make out of this entire consolidation merger process?
See, one, I think PSU banks, the large ones, are fairly sustainable. I don't think there is a challenge, and we own them. And as I said, we don't think ownership makes that big a difference. The asset quality has made all the difference. And asset quality will, for private corporate banks or public corporate banks, should move in tandem broadly. So I think they should improve. I think merger is a great thing, and even the last time around, I fail to understand why merger between 2-3 similar banks can hurt anyone. So you have taken care to merge banks with the similar same IT
Technology
platforms.
yeah.
The pay scales are same. You will just bring more scale. You will over
Streamline
time be
the
able
process.
to rationalize costs, overhead costs like treasury function, HR, or the IT costs could drop. And the bigger the bank, the more you can spend on IT, which is becoming clearly key. The bigger companies you can deal with. So I think, to my mind, I don't see any downside to this merger, and over time there should be meaningful efficiency gains.
All right, got that. Prashant, it was really great chatting with you.
Pleasure.
Thank you so much for
Pleasure.
joining us this morning.
Thank you.